In this video, I want to go over firm financial statements. In order to evaluate how a firm is doing, we need to look at many different statements that accountants put together for us. They help managers make the best decisions to get the best results. There's, like I said, a variety of these statements, but we're going to focus on the two big ones. That is the income statement and, in a minute, the balance sheet. So let's start out with this income statement. Income flows over a period of time. And so this is a statement that shows flows of money into and out of the business over time. Revenues represent money that comes into the business from sales. So revenue and sales are the same thing. If you sell 100 widgets at $1 each, you have $100 in revenue. Costs flow out of the business. I like to think of revenues coming in the front door from the sales of product and costs going out the back door to pay for all the resources necessary to produce the product. Things like wages for workers or interest on loans, maybe rent on the property where the business operates. And then the difference between revenue and costs is profit. The reason firms exist is to generate a profit. And that means more revenue than costs. Firms operate over the course of a fiscal year. For a lot of firms, this corresponds to the calendar year, January 1st through December 31st. But for some companies, they choose a different start and finish for the year. Some might start July 1st. Some might start October 1st. But regardless of when they start, they run a full 365 days. And that period for the firm is called the fiscal year. So when we look at a statement, for example, Twitter's income statement for 2018, it will be for the 1 year period that Twitter brought in revenue, costs, and profit. Revenue is pretty straightforward. Like I said, it's sales. Costs, a little more complicated. For accountants, the costs are generally called operating expenses. So you'll sometimes see this on accounting statements. Costs can be broken down into two categories. There's explicit costs and implicit costs. If you add these two together, you get what's called opportunity costs, which is the total costs or operating expenses of the business. Explicit costs are costs that are incurred to acquire a resource the firm doesn't own. If I open up a little burger stand and I have to pay workers and I have to pay rent for the property, well, I'm paying other people for the resources they bring to my business. And so those are explicit costs because I don't own those resources. I'm having to go into the labor market and into the real estate market in order to transact with someone to get those resources. It's called explicit because you can see it. There's a market transaction. You can look at the payroll statement. You can look at the lease agreement and see these costs. Implicit costs, in contrast, are incurred in the use of a resource the firm owns. So if I work in my own business, I'm not hiring anybody. I'm not paying a wage, but there is a cost to my time because I could have worked somewhere else, right? So I am giving something up, and that needs to be considered. Similarly, if I use my own house that I own for my business, well, I'm not paying a landlord rent. There's no explicit kind of cost that you can see, but there's a cost because if I didn't use the house in my business, then I could rent that house out to somebody else, and I'm giving that up. So whether I'm using my own time or my own residence, maybe I use my own savings, in each instance, I'm giving something up. I give up interest on the money that I bring into the business that I pull out of my savings account. If you add up explicit and implicit costs, you get the opportunity costs, and this is the only thing that matters when it comes to costs. You have to be very careful when assessing the profitability of a company because you want to make sure that you look at all revenue and you consider all costs so that you get a good sense of whether the company is profitable or not. Profits are the difference between revenue and costs. And for accountants, this is sometimes called net income. So you usually see this term on accounting statements. An accounting profit takes revenue and subtracts explicit costs. An economic profit takes revenue and subtracts opportunity costs, meaning it takes revenue and backs out both explicit and implicit. Economic profit is what matters for the business, because this is the one that considers those implicit costs that matter. Again, if I work in my business and I use my own savings in the business and I use my own house, I'm bringing in a lot of resources and I'm giving up earning a return on those resources in another manner. I need to consider those foregone returns. And that's why implicit costs should always be taken into consideration when calculating profit. The challenge, of course, is it's hard sometimes to find these. And that is, accountants would strive to get from this measure of profit to this one. But to the extent they fail to consider implicit costs, because there's no receipt, there's no market transaction they can look at, it's not explicit, then they might miss them. And in that case, they would overstate profit. One thing to note is accounting profit would always be either the same or greater than economic profit. Let's take a look at Twitter's income statement in 2018 to just illustrate this process. So Twitter brought in these are in millions, so we're going to add 6 zeros. So this is $3 billion in revenue. They had some operating expenses, right, some costs, and it breaks them down here, a variety of different ones. If you add up all of them, all 4 of these categories here, you'll get the total cost of essentially $2,589,000,000. Okay. They also generated some income from their operations of $453. This is simply the difference between the revenue, sales, and the operating expenses. So they have an income from operations of $453 million. Now, they earned some interest, or they paid interest. Okay, most companies either have bonds that they've issued, and therefore they have to pay the interest on those bonds to borrow that money, or they actually own bonds of other companies and they're getting interest. So companies can be investors just like you and I. If they've got some cash sitting around, they might buy some bonds just like you and I would and get a return. But oftentimes they're selling bonds and paying that interest. If you see in an income statement brackets, that means negative. So in this case, it looks like they have net interest payments of $21 million, meaning that they issued bonds and borrowed money and they had an interest expense that shows up here. They also have other expenses of 8, and that's a negative 2. So we take the income from operations, which is profit, effectively up to this point, and then we back out that interest that they paid on their own bonds and other expenses, and we get to income before income taxes. Of course, when companies operate in every country in the world, they have to pay taxes. The company itself has to pay taxes. If you recall the corporate tax, that is specifically hitting the profitability of the company before any shareholder gets dividends. So this is their income before income taxes. Then they got to pay taxes. Now, this is an interesting case because you'll notice this is not in brackets. This is their net tax. It's not their net tax cost. It's their net tax benefit. Meaning for Twitter, they actually got what we call a tax rebate. They probably overpaid in prior years. So they're able to take the income they earned before income taxes of $424 million and then add to that the $782 million that they got in a tax rebate. So their net income is $1,206,000. So just an illustration of the kinds of flows that we would see in a real-world company. Revenues coming in from sales, and they have all their operating expenses they got to back out. They got to borrow money, so they got to pay that interest on those bonds or bank loans. They have other expenses. That leaves them with income, but then they got to pay taxes, or they get a tax rebate. And that gets us to net income, also known as accounting profit. Let's take a look at the next type of financial statement. Here we have a balance sheet. This is also for Twitter. Now, unlike an income statement, a balance sheet shows what a company owns and what it owes. It's a snapshot at a point in time. It's not over a fiscal year. It's usually taken at the end of a fiscal year. For Twitter, they run their fiscal year with the calendar. So their last day for 2018 would have been December 31st. It documents assets, liabilities, and net worth. Assets are on the left, liabilities are on the right. The difference between assets and liabilities is stockholder equity. Stockholder equity is a type of liability because it is owed to the firm. To the shareholder, the stockholders. An example of this might be if you took a company and sold off all their assets, and then you paid off their liabilities to outsiders, what they owe outsiders, you'd be left with some money. Well, that would be owed to the stockholders. So that's why both liabilities and stockholders' equity are on the right side. It must balance out. That's why we call it a balance sheet. Let's take a look. So for Twitter, they had current assets. They owned $7,111,000,000 worth on December 31st of 2018. Current assets are assets that could be sold off for cash within a year. Selling off assets for cash is called liquidation. So these are assets that could be liquidated in a pretty timely fashion. If they had an emergency, they could get rid of these assets within a year and get the cash needed to pay whatever emergency bill they have. So current assets are the most liquid form of assets the company has. Then you have property and equipment, and you have goodwill, and then you have other assets. These three would not be current assets. That means these three would take over a year to liquidate, to convert into cash. So really it's current assets versus non-current assets, but they just subdivide these non-current assets into three categories. And so if you add up all of this, you're going to get $10,163,000,000. Okay. Some of you might be wondering, what is goodwill? Goodwill is effectively the value of the company's name. If you look at the name Twitter, it has value because people know it, they recognize it, and investors might be willing to pay for that. Even if Twitter didn't own any equipment or they didn't have any current assets or any other assets, if there was nothing left but that trademark, Twitter, people would be willing to pay money to get that Twitter. And at this point in time, it was worth over $1 billion. Okay. So add them up, you get 10 billion. Now liabilities, this is what's owed. Current liabilities are what is owed within a year. This could be a 6-month bond that they have to pay off, or a 10-week bond or something. It could be a bank loan that's less than a year in maturity. And it could be other obligations, contracts for product, and so forth that they have to make good on within a year. Long-term liabilities are non-current, which means these would be over a year. A bond that matures 2 years from now or 10 years from now. A bank loan that's not due for 20 years, that kind of thing. If you add these two up, you get total liabilities. Okay. Note again that when we're looking at total assets, you have current and non-current. And when you're looking at total liabilities, you have current and non-current, long-term. Now, notice that by adding these two together, you get $3,357,000,000. So what would happen if you took all these assets of the company, sold them off, paid off those liabilities? Well, you would be left with some money, wouldn't you? And that money belongs. It is owed to the stockholders. So the difference between the $10,163,000,000 and the $3,357,000,000, this minus this is this. And therefore, if you add up the liabilities with the stockholder equity, you get 10 billion. This is the great equalizer. This ensures that whatever assets are owned above and beyond the liabilities that are owed belongs to the shareholders, the stockholders. So we call this a balance sheet because it perfectly balances out in the end.